This podcast is brought to you by Eastspring Investments Berhad.
In the first quarter of this year, Malaysia has been hit by a triple whammy in the form of a change in government, crashing oil prices, and now COVID-19, which has paralyzed the global economy. The FBMK LCI has corrected by 15.5%, and our ringgit hit 4.44 in February before strengthening slightly to 4.35 now. The threat of an impending global recession is getting stronger. For Malaysia, most economists have revised down our GDP growth forecast for this year to a negative year-on-year number. COVID-19 is an unprecedented global health crisis involving drastic lockdowns in various countries. This has led to both a demand and supply shock to the global economy and is causing major disruptions in the flow of goods and services all over the world. This is directly hitting the revenue of businesses as they struggle to stay afloat. This health crisis is showing signs of triggering a global recession. The question now is, how long will the slowdown last? Will the rebound be V-shaped, U-shaped, or L-shaped? Is there going to be a long-lasting economic depression? In the meantime, what should we do? Now, the shape of recovery depends on three things in the following order: containment, stabilization, and recovery. First of all, it is all about containment now and the breaking of the chain of transmission. Once the virus is contained, we will have stabilization. Governments all over the world, including Malaysia, have used a combination of fiscal and monetary policies to soften the knock-on effect of the lockdowns. These policies aim to temporarily put cash directly into the hands of individuals so that they can remain employed, as well as businesses so that they will not go down under, due to tight cash flows. Bank Negara has also cut interest rates twice this year by a total of 50 basis points, bringing OPR to 2.5%. and reduce SRR from 3% to 2% to ensure sufficient liquidity in the financial system. After the situation stabilizes, we will see recovery where the flow of goods and services resume and people begin to spend again and businesses come out of cash conservation mode to once again begin investing. Now, the question is, how long will demand take to normalize? We see that while China returns to work, demand is slow to return as other countries are still in lockdown. We will monitor the pandemic as it develops over the next few weeks. As the situation is fluid, any forecast is probably unreliable at best. Further out in May, we expect political risks to increase as the Malaysian Parliament reconvenes. Beyond that, we also expect the first quarter and second quarter corporate earnings to be slashed. The low oil prices will also have a negative impact on our fiscal position. Now, having said all that, our portfolios are defensively positioned as we had raised cash earlier, and that has worked out well to protect our portfolios on the downside. Our portfolios are long-term portfolios, and for long-term portfolios, the recent market fall has presented us with opportunities to pick up beaten down good quality names at reasonable prices. As the pandemic peaks, investors will be more willing to look through the expected ugly macro data and weak corporate earnings and begin pricing in a rebound. This is because we believe the virus will not cause a long-term economic depression, as the economies will slowly recover once we achieve containment and stabilization. So, we remain very focused in this risk-off environment as we continue to practice discipline in stock selection and vigilance in asset allocation decisions. As interest rates are on a downtrend, our investment case to stay invested in equities and fixed income remains relevant on a relative return standpoint. We like quality names that demonstrate business resilience with strong cash flows and reasonable dividend yields to provide income in a volatile market. So, stay calm and think long term. Stay invested and, more importantly, stay at home.